Excellent. I'd like to call to order the meeting on May 10th of the pension board and seek approval of the minutes from April 12th.
Motion to approve. Second.
All in favor? Aye.
Aye.
Is there any public comment? There's no public comment. We'd like approval of the pension applications. There's 3 applications.
Hello, so we have 3 applications tonight. The first is Nancy Griffin. She's from the Board of Ed. She was a nurse. She was employed with the Board of Ed for 15 years, 8 months. She is seeking a regular pension and she has selected the standard option. David Rauscher, Department of Public Works. He was a mechanic. He was with the city for 26 years and 4 months. He is also seeking a regular pension. He has selected option 2. And lastly, Kathleen Rauscher, who worked with the library as a library assistant. She was with the city for 13 years, 7 months. She's retiring on a regular pension and has selected option 2. We request approval of those pension applications.
Anybody have any questions on these? I looked them over. It seems to be fine. Good. Is there a motion to approve the pensions?
Motion to approve.
Second,
Second.
any discussion? If not, all in favor? Aye.
Aye.
Opposed? No, thank you very much.
One quick thing to note, just on, then I do the pensions, on the line where it says submitted to the board for approval. There's approved and then there's disapproved is spelled wrong.
Oh, I'm not looking at that sheet.
Okay,
There-
yeah.
I will fix that.
Yeah.
I'm sorry about that.
Not a big deal.
I'm gonna go get Principal Dynamics. Any question about them? That's Columbus Circle, isn't it?
Mhm.
Yeah. You can just change the name. All right. Look at these guys.
I'll sit back here. so that we can-
Learning how to use a tab.
I have a mouse that I use.
You got
And you're the
a
one
lot
that
of
has to travel.
those.
So,
Just one more.
Yeah. Brett's hanging out there. Let me see how we're gonna do this. You know what, why don't we, can we use those, can we put them towards the end here? Because we get a whole team of them here.
I'll sit wherever.
We don't like to come alone.
You want to sit with that?
Yeah, yeah, that's
Or you
fine.
can sit up here, Kevin.
Oh, yeah, sit
There's
here.
a seat here too.
Sit here, we'll get
And then
them
we
down
got,
there.
we got 1, 2, 3 there, that'd be perfect.
Okay.
Okay?
Okay, so over there.
Yeah.
Yeah.
Isn't
Hi,
that-
Frank Maureen Hayes.
Hi.
Nice to
Hi,
see you.
hi.
Jim Henderson.
Excuse me.
Perfect. Nice to meet
Morning.
Great.
Frank Maureen Hayes. Nice to see you.
Nice to meet you.
Rich
Small-
bastard.
We have a small room, but we're meeting in person, so that's good.
Are you sure? Yes.
I'm not sitting here, I guess.
Let me just give you some hard copies of the book in case that will be easier.
I'm good. Again,
Yeah,
I got you too.
perfect.
Thank you.
Jonathan?
If they have an action, I'll grab them.
Should-
Yeah, oh, I'm sorry.
No, no, that's fine. That you.
Do you want to sit over here so you understand?
It doesn't bother me.
I'm sure.
Yeah, actually, I'll switch.
The owl will follow you.
Oh, the camera will follow us?
Yeah.
Camera up
There you go.
there. She'll follow you as you're talking.
Okay, I just didn't want to take away the good treatment. Do you want us to jump in or is there anything that needs to be
Yep, go ahead.
set ahead of
Jump right
time? Great, thank you. Let me just make a few introductions. I'm Maureen Hayes from Principal Asset Management, the Dynamic Growth Team. I actually work directly with Catlin. I'm a consultant relations person. I'm here with our 2 PMs, Chris Corbett and Mark Shapiro. So we're delighted to be here. I want to start off first, thanking you for your business and your confidence over the years. We're delighted to be here in person. COVID was a little fun to do things virtually, but we kind of all moved on and like to be in person. So is my understanding correct that we have about 30 minutes or how is your timing today?
Depends on how well you did the last 2 weeks.
Okay, that's a tough hurdle.
Okay, I'm only kidding. No, 30 minutes or whatever. We don't need too much about you know, where you guys all went to school and
Yeah.
blah, blah, blah. And we just want to, what your concepts are, what your positions are, et cetera, what your philosophy is, things like that.
Yep, perfect, understood. I wasn't gonna go through big bios. I just wanted to do just a brief, quick, like 30-second refresher. Your principal, the dynamic growth team had been named CCI, Columbus Circle Investors. And, sorry, Columbus Circle Investors. And when Cliff Fox, who was one of the founders, retired 2 years ago, principal, the primary owner of CCI, absorbed the team into our equity boutique. And I think that proved to be very fortuitous, given the market conditions. I know some small and mid-cap managers had gone out of business, so they have broader resources than they had before, global trading desks, operational support. I think the team would share with you that that has proved to be very resourceful and a benefit to their future.
When did that exactly happen?
That happened, Cliff retired in 2021, right?
No, it was,
I'm sorry.
I believe it was, he was not really involved most of 2020.
Sure, you're
Formally
Yes.
became a senior.
Advisor.
Senior advisor in
thank you.
mid 2020, if I'm getting that.
Any
Yeah.
personnel fallout from that or been seamless?
You know, it was pretty seamless. Both Mark and Chris and Mark had worked with Cliff for over 15 years at the time. Mark has been at the firm close to 20 years, I think 19, and Chris has been there 17.
Mhm.
So they were already a very tightly knitted group
Okay.
together. So there wasn't a very significant fallout. It was almost business as usual, handing over the keys to people that he had trusted and necessarily, taught in some
Yeah.
ways the business to.
Okay.
And the only real turnover we've had over the last year is we had a junior analyst leave last June, and we've actually replaced her internally with it's an engineer. She's a part of the R&D data team out in Des Moines for principal, and she's had been involved in the market, and she's working out really well so far.
Okay, good.
All right, so let me just turn it over to Chris to lead the investment discussion. We thought we would talk about, performance, what happened, how we're positioned in our market outlook, and happy to engage in any questions and curiosity you have throughout the discussion.
Sure. If everybody feel free to jump in with any questions you have at any point, if I'm giving you too much detail or not enough. So I guess I would probably start, on page 5, where we can give you a little quick refresher on our process and exactly what it is that we do. Our discipline has always been called fundamental momentum, positive surprise. And what we're looking to do is we're looking to invest in companies that are where results are getting stronger, positive momentum, and exceeding expectations. Some people require one or the other. We require both. That often leads people to the question: is there some growth rate that you want to see from your companies before you put them in the portfolio? The answer is no. As long as growth is improving and we don't feel it's being rewarded by the market and it's going to result in positive surprise. One of the things that we do best as a firm, and I think one of our key differentiators, is you won't see us doing a lot of DCF models and detailed channel checks. Our philosophy has been based on the premise that it's easier to identify change than it is to value a stock. So what we tend to do is through our years of experience, we have a pretty seasoned analyst team, except for maybe a junior person or two. We're able to distill, company fundamentals down into like the 2 or 3 or 4 pieces of information that if you knew them in advance, you'd be able to opine on what the sales and earnings might do at the end of the quarter, at the end of a year, at the end of the next year. So what we call those are our essential story elements. They come in 4 flavors. Mark, you want to talk a little bit about those real quick?
Sure. So we seek to identify change and positive momentum, positive surprise from essentially 4 buckets of essential story elements. The first is company specific. So that could be a new product that's gaining, share in the marketplace at a faster than expected clip. It could be a change in management, which is leading to, a change in kind of pricing philosophy that's driving upside to margins. That's on the company specific side. And then there's 3 other buckets. One is secular. So that would be kind of, think of the most common, in today's world, is the electrification of certain industries. So it's our EVs tracking, adoption, tracking ahead of expectations. It could be this factory automation adoption by some of the larger, industrial companies or Walmarts of the world tracking ahead of expectations. It could be industry, which would be a change in the competitive dynamic. Let's say number 4 player gets acquired by the number 3 player, which leads to better pricing for everyone in that group, leading to positive surprise. And the last, which is the last one, which we tend to not favor or weight heavily, is the economic, just because we don't have an edge there as much as the other 3. So that would be, change in interest rates, a change in employment picture, additional fiscal stimulus, et cetera. So I think if Chris doesn't mind, I'll take it. Like one of our large, I'll just keep, I think it's easier just to explain it, using a name that we own today. Inspire, which is a medical technology company for sleep apnea. They're basically replacing kind of the CPAP for sleep apnea. So the company specific is a new product, which is a nerve stimulation technology that's gaining share at a faster than expected clip. The other company specific driver of positive surprise and positive momentum is that they have a direct to consumer initiative that's driving better customer acquisition costs, which is driving better top line and better bottom line results. So that's the company specific aspect. And the secular, this is kind of broad, but it's just general medical technology, kind of next generation medical technology, replacing kind of the CPAP of the world. And then probably the one that we had latched onto last year, specifically on the industry side, was one of the largest CPAP manufacturers went through a major recall. So that, if you're a user of a CPAP machine and your device has a recall, you're going to go out and probably talk to your doctor and seek maybe other options. And so that's led to an acceleration of Inspire's market share in the sleep apnea business.
So just like Inspire, just to understand how you got involved in it. So how long has that company been public?
Inspire's been public for probably, I'd say, 4 to 5 years, something.
And when did you get in?
So we've owned it over the life of the company at times.
You bought IPO?
I don't think we bought the IPO. Because yeah, we looked for evidence of the adoption of their device to be tracking ahead of expectations. We bought it. Almost positive we bought it on the approval by the FDA for their device, and then typically in a medical device company or some type of biotech, what we'll do is we'll wait for that approval by the FDA and then do channel checks with third parties in terms of what doctors' opinions are of that device or that, and try to gauge that qualitative commentary or opinion relative to the quantitative expectations that are out on Wall Street. And that's
At that time, did it meet the 4 criteria at that time, or was it premature? Or was it kind of early decision to go with it?
I'm sorry, so it doesn't need to meet all 4 buckets of essential story elements, as long as there is at least 1 or 2 that it does meet. And so those checks that doctors were enthusiastic about prescribing this, or the surgeons were enthusiastic about adopting this technology, was the key essential story element at that time to make the purchase. And just the medical technology companies is there's, I always thought, before I covered the industry, I always thought, well, if it's a better solution, then all the surgeons are going to go run out and perform that surgery on the patient. But that's actually not how the world works. It needs to be economic for the surgeon, right? So all these surgeons look at how many minutes does it take for the procedure relative to what else I could be using my time for. It checked that box. Better outcomes relative to CPAP. It checked that box, and then does it have commercial payer coverage? So like Blue Cross Blue Shield of the world, are they accepting the therapy or the technology? And it did check all 3 boxes.
So how do you go about sizing up that kind of an idea?
Well, any idea that we buy is that our initial position size is 50 basis points, and where we add to it as there's evidence that our thesis is is, I guess, coming to fruition. We're very evidence-based
You
decision
do it like
makers.
in 25 basis point hunks, 50, what's your max size that you trim?
The max size of our
Right.
position is 5%.
Mhm.
Generally, we'll add to it up to 3%. And if it goes from 3 to 5, it's generally through
It's-
appreciation
okay.
of the idea. You know, the amount we add is, I guess, relative to how much evidence we see, of how much validation we get of the concept.
Mhm.
For instance, I remember like when we first bought Inspire, I mean, to really think, we don't tend to love IPOs, like, we won't just buy a concept. We
Yeah,
like to
get
see the
stuck.
results seasoned for
Yeah,
a couple quarters. So, you know, Inspire, there's the FDA approval. I remember at the time, I've written before COVID, actually, one of the things that we added on was that they received the Blue Cross Blue Shield approval, reimbursement. There was a determination letter that came out and they got that. So that was an ad. And then I think a couple others followed. I don't remember who they were at this point in time because it was 5 years ago, but, you know, and then, you know, so we built the position through that. You know, as they reported, the viral adoption in part of the results, there goes off new pieces of information there that maybe it was, they were open new centers or the doctors were, you know, more doctors were doing more procedures. It was like little data points like that along the way. So if we get, often our essential story elements are leading indicators. So as long as we get those right, you know, the earnings report should theoretically be the caboose of the train. You know, we've invested, hopefully the market applauds, we make money because the stock's up 5, 10, 15%. And, you know, we reassess any new information that comes out on that quarter and compare that to what, you know.
How do you evaluate it if ideas played out? You know, you have your research differentiation, you make your alpha, the market catches up to you. And it's not necessarily that you're wrong,
Yeah,
but it's time to deploy the capital somewhere else. How do you, is that a formal process? How do you do that?
No, it's, I wouldn't say it's formal per se all the time, right? It's part of our, every day, we're constantly reassessing new information, whether it's a data point that comes out on a specific idea against what the expectations are. If we get a data point on a leading indicator that is, you know, missing expectations, or we think expectations might come down and that's a permanent change. You know, like for a retailer, if it was weather, we might be willing to look through that, those type of things. But if we think something's going to start missing expectations, we will reduce it and sell it there. Sometimes it can be as simple as, you know, maybe a stock's had a 4 or 5 quarter run where they've blown out, you know, sales and earnings, and, you know, and maybe in Inspire's case, it's the number of implantations of their device for a number of quarters, but maybe the stock doesn't go up anymore. You know, maybe you get like a 20% earnings and revenue beat and the stock is kind of, it's up 1%. You know, that, well, what did we miss here? And we start questioning ourselves, and maybe it's, you know, things have caught up with expectations, have caught up with reality.
Yeah,
It's sometimes-
sales discipline is sometimes harder than
Yeah.
the buy
Yeah.
decision.
Yeah, so I mean, we do, you know, as I say in the second column here of our, and on that page 5, we do use both a thematic and a technical overlay. And by technicals, we never buy or sell stock purely on technicals, but the technicals will cause us to ask questions if there's a new idea that looks like, hey, this chart's something that's been doing nothing for 20 years. And look, looks like there's some accumulation going on there. Hey, analysts, take a look at it and see if there's a story here that might be something we're interested in. Alternatively, like if it's, you know, if we think the stock should have been up on a piece of news and it's down, we kind of ask harder questions of our analysts. Are we missing something here? I'd say one of the common things when that happens is sometimes we feel an idea might be more secular than cyclical, and there's probably a little more cyclicality to it than we appreciated at the end. But generally, if we're able to identify these open-ended secular growers, disruptors with high company specific stories, we're generally pretty good at doing that. We may not be out exactly at the top, but if we're paying attention, you know, the initial thesis on an initial product, say, you know, you might know if like a software company is up to 50% penetration of the industry or something like that. I remember Ellie Mae and the mortgage related software, we own that. It got to be about 50%. And I started getting worried about when I was an analyst that, you know, wow, that's a pretty high level. It's going to be harder for them to go from 50% to 60 or even 70. So kind of, there's little things like that. There's, you know, competitive concerns. A lot of times though, it ends up being like you get a piece of news that isn't, you know, as positive, and it just kind of, the stock doesn't react how you thought it would, and you start asking tougher questions, and, you know, maybe you either find your answer, maybe it's a temporary thing and you still hold it, but oftentimes it can be wild. People are starting to pick up that maybe there's a competitive product or you've reached a penetration point.
Okay,
So-
thanks.
How many stocks does each analyst cover, both that are in the portfolio and that are watching to come in maybe?
Yeah, formally, like within the portfolio, I'd say 20 to 30 each, perhaps, or somewhere around that, because they work on our small cap product, our SMID product, and our mid cap product. And then probably, you know, I'd say 150 to 200 stocks that they don't follow. And that sounds like a lot, but it's not formal coverage of every name at every quarter. You know, if we sell something, you know, say we sold something 6 months ago, they may look at the earnings report, you know, last week that, you know, and they know the name already. It's easy to get quickly back up to speed. They know what to look for in terms of change, because we're trying to identify change in the delta. So there's a lot of names they're familiar with.
So they cover maybe 20 or 30 that are in the portfolio. Is there another group that are, you're kind of watching to
Yeah,
possibly buy, and how big is that?
I'd say it's probably equal at any given time. There's probably, you know, 10 stocks that they're thinking about actively in terms of buying, but they're always evaluating every new piece of information that comes out on any idea in their area every day.
There's also overlapping in themes. So, you know, you take within like you know, think about semiconductors, you know, a secular theme is silicon carbide penetration within semiconductors. So, you know, you can track the rate of adoption of silicon carbide, and they go mostly into electric vehicles today. And that, you know, that's the key ESE for a handful of stocks. So you still have to understand the company specific element of each stock, but you can easily group usually at least a handful with this common theme, which makes it more efficient and easier to cover, you know, could be 20 or 30 stocks.
What's the least market cap you'll buy?
We will buy, you know, depending on the positive, so the SMID will buy any stock that is within the market cap range currently of the Russell 2500 growth. So that's about, I was looking at that today. I think the top, whatever quantity is, what's that, 22, 23 billion is the top end. That'll get rebalanced down to about 16, I think, in another month when the Russell rebalances. And then down on the lower end, it's pretty small. So it's anything that's, I'd say I think there's stocks in the Russell 2500 that are sub 200 million in market cap, but for all practical
That's tough
purposes.
to do a 50 basis point position, isn't it?
Yeah, all practical purposes, 500 million in liquid.
Yeah. Okay. All right.
Will you ride them all the way up, you know, from a small cap level all the way through mid cap, or like what's the frequency that actually happens where you stay with the name?
Well, there's definitely names that will own across all three portfolios.
Yeah.
I mean, I think maybe the most prominent example of it over the years was ServiceNow. We bought that shortly after the IPO. Like I said, we don't usually invest in IPOs, but we knew that company from, you know, they competed with Computer Associates and BMC for a long time, and we knew they were disrupting those companies. So we had got to know them a little bit before the IPO. When they came public, they had IT service desk management leg, which is like, you know, tickets into corporate for your, you know, for your computer problem, and, you know, tracks it through. So somebody follows up with you and is it complete? Okay, this problem's over. It's resolved. So they came out with a SaaS solution to disrupt that market. They were doing really well. At the time of the IPO, I remember thinking like if they got to 50% penetration, I'll say it was like a 2 billion, they could have got to maybe 2 billion in revenue. And at the time, the prevailing software multiples were maybe 5 or 6 times revenue. So, you know, you could think it could get to maybe be a, what's that, like a 2 billion times, so like 10, $12 billion company. But as we own the stock, you know, I think it got to the upper end of the market cap range for small cap, which was probably about 8 billion at the time. We started hearing more and more about some new products that they were developing. So legs 2, 3 of the stories started coming to fruition, and you started getting some validation on them. I remember there was an HR solution where they you know, there was like 20 people took it in the first quarter of availability or something like that. And we started doing the math on what that TAM, you know, addressable market could be for them. And started looking, you started getting some pretty big numbers. Over the years, they've expanded to more and more of the software markets. So I think when the HR product came about, we bought it actually in the SMID product, you know, and it was such a good idea. After a couple of quarters, we'd also put it in the mid-cap product. Eventually, I think it got pretty big for the SMID product, and you know, it might hit like a transitory soft patch for like a quarter or two, and the stock wasn't performing, but there was plenty of other software names that were performing. So we sold it out of SMID and reallocated the capital to other software ideas. But it rode in mid cap for another, you know, 3 years, and eventually it went out of the top end of that market cap range. So that's kind of the, you know, how it progresses. I mean, we don't have a hard and fast rule of we sell it when it goes through the top end of the index. We'll ride it as long as we think the story's there, it's positively surprising, we think it's going to contribute to the alpha of the portfolio. But you know, we're cognizant of like if something you know, if the top end's 20 billion now and stocks run to 35 billion and it's, you know, 50% extended above the moving averages, has had like, you know, 20 straight weeks up or something like that, and maybe there's gonna negative data point that looks like it wants to correct, we'll just move on. So that's kind of the way that we think about that.
How do you do sector allocation? Because when I'm looking at page 17, and particularly in healthcare, which is a big source of performance for SMID and mid, you've gone from 21% in healthcare down to 13% in March. That's a huge.
Yeah.
You cut it from 15% as of September 20. I mean, is that just the way thing works, or you decided that healthcare is not where you want to be right now?
Well, that's every idea comes in the portfolio on a bottoms up basis.
Mhm.
So this is really a fallout of that. At the time, I guess in September, like last summer in September, we had a relatively big theme in value-based care. I think Signify Health was one of the companies in that area. They're I guess essentially a partner to the managed care programs, where they're putting down using their tools and software and IT resources to come up with a better outcome for the patient, and eventually they'll share in the savings, but in the near term they're paid on number of lives and you know, in a favorable manner. They were taken out by CVS Health, and we're seeing positively surprising results out of another company, Privia and Evolent Health. And you know, so part of the reduction was because Signify got taken out by CVS, so we sold it. It was you know, it had been a successful winner. EVH, I think, may have been close to the biggest position. Evolent Health, EVH, was close to one of the bigger positions at that time of last summer. And I remember sitting in our New York office on I think it was September or October, early October, and they made the announcement that one of their customers was losing funding or something like that, and it wasn't anything they had done, but the plan was going away, and they had built that into part of their growth forecast. So we immediately took a real big reduction of that position, as well as Privia, because we thought, hey, you know, these things are reacting negatively. You know, we're attuned to the behavioral and that sort of aspect of it as well, where you're you're getting reinforcement that, hey, something just happened to one of the bigger value-based care plays, let's reduce them all. And we did. So that was part of it. There was also some defensive names that we owned, the more on the services side, that had been good stocks. And as the October CPI print came out cooler than expected, the market was starting to rotate away from those. And at the same time, you were seeing some inflation in the labor component of those companies. So they were you know, so we exited those quickly. I'd say generally speaking, though, our maybe not so much in SMID, but definitely a little bit in SMID. You know, we're not huge fans of biotech in general, because you know, it's a lot of binary events, you know, small and mid cap biotech. So if we don't have to play them, we won't. And it's too much of like when we track our ESEs, we like to have, you know, a thesis, and we like to have very evidence that it's being validated, whereas, you know, the drug trial happens, nobody knows the result, and at the end of it, it's like the Oscars, right? And the envelope please, and the stocks up or down 30%. So, you know, I think biotech's maybe 300 basis points in the SMID index. So there, I think we own one stock right now, tied to Alzheimer's, that's you know, that's in there, but we're probably 200 and some basis points underweight biotech, and that's underweight that, so that's part of it as well.
What are you, you had a somewhat, you know, SMID was a tough area last year, and your excess return was minus 3.5,
Yes.
4.35%, but you had 3% cash, which kind of 3% cash at a 5% return kind of helps a lot.
Yeah.
What, I mean, what are you looking, is that led you to, you know, that amount of underperformance, is that led you to look for areas of marginal improvement, or what you can do better, or continuous improvement? I mean, what's your game plan to get back on the positive side of excess return
Yeah.
without having 3% cash?
Yeah, of course. The, you know, so last year, looking at the performance, you know, we had done pretty, I'm not gonna say we did well when you're down, or whatever, we ended up down last year, 20-some%, right? On a, absolute base, the market's terrible, right? So, but on a relative basis, we were hanging in there pretty well through like September.
Mhm.
And what happened is very, I guess I won't say common, but it's similar to what we've seen at other points in our history. Like probably maybe the most recent example would have been 2019 during the Trump China tariffs. Whether are they going to be removed, or they're not going to be removed? And you get a big cyclical rally, I think, in the fourth quarter of 2019. And what happens is, you know, our portfolios are generally populated with companies that are, you know, very high high growth sales rates. Even though I say there's no minimum percentage of you know, sales growth to get in the portfolio. Our process leads us into companies that are very dynamic, very high growth. We'd be in the high end of the growth pool. So you have to be very careful not to, you know, not to give that performance back in times when, you know, and
Yeah, if the multiplier goes away, you're
yeah, exactly.
stuck.
Exactly, right. So
Especially when there's not a lot of volume.
yeah. So
Where's that bid?
yeah. Yeah.
Call me tomorrow.
So, you know, it was almost like I guess I'd say a perfect storm, like of a toxic combination for us in October when the October CPI print came in cooler than expected. The combination of positioning and negative sentiment overall. What we characterize it, I guess, as a short covering rally that, you know, it began in October and it continued right through the end of the year almost, where, you know, hedge funds were selling their longs to cover their shorts. So we typically own a lot of stocks that were much more like their longs. We rarely own any that are you know, like shorts, what we call them a junk rally almost, right? Where the stock's gone from, I don't know, $100 to $20, and, you know, it bounces off the bottom from 20 to 40 or something like that. You know, and then so in the quarter after when that happened, you saw sales growth as a factor overall. Like the fastest sales growers were down 1%, which would be emblematic of our portfolio, while the weakest companies in the index with sales growth were up 8%. You know, and also within the industries, there's a value skew, and we're, you know, typically in tech, healthcare, consumer to the extent we could be. You know, value, I think there's a 400 basis point spread over performance of value names versus growth names. And then within the indices as well, the cheapest names in the index were up like 10% plus, while
Yeah, it's a junk rally.
Yeah, exactly. And that's, that is, that's happened to us from time to time where, we're very cognizant of it. We had been moving in that direction to trim some winners in September. Probably didn't do it as quick as we should have. When we started repositioning the portfolio, we were leaning more into, at that time, we were probably a little bit more defensive. We had started to lean more into our secular growth roots, and we continue to do that as we've entered the first quarter. We dug ourselves a little bit of a hole the first week of January because the January effect was very strong, the first 2 weeks, which was more of the same from the third quarter. It sort of settled down in mid-January. As the February, I guess in February, there's a hotter CPI print, and that kind of brought correlations down, which was helpful to us. Silicon Valley Bank, going under that week. I mean, we actually did own it. Unfortunately, we acted very quickly to get it out of the portfolio and sold it that morning at like 9:30 and exited the position entirely before it went to zero. So
9:30 on Thursday, that would have been.
yeah.
On the open, something in that.
Yeah.
So on something like Silicon Valley or any bank, I mean, do you drill in deep enough to see that they had a liability mismatch like that, interest rate mismatch that
Well, yeah, I mean,
killed them?
yeah, I mean, so I'll start off by saying they had obviously a big mismatch on the liability side, but a lot of banks that have low loan to deposit ratios have the same issue because they have to take those excess deposits and invest them in securities, right? So we've been doing that for the last 3 or 4 years. As rates moved higher, most of your securities were underwater, right? If you had to mark to market them today, right? And then obviously the Fed stepped in and, basically allowed them to lend those securities back to them at par, right? To alleviate that problem.
I guess what I'm asking, how much of what was all revealed after the fact could you see before it tanked?
Yeah, we knew that there was they have 2 securities portfolios. They have the held for sale and the held to maturities portfolio. We knew both of them were underwater. But on the fourth quarter report and the intra-quarter Q1 meetings with management, the way they get in trouble is obviously if they have a run on the bank, right? And the deposits start to outflow. As of 2 weeks before they announced the updated guidance and announced the secondary to fill the gap on the held for sale portfolio, they were talking about deposit growth. So it's something that we were aware of, but one of the key essential story elements was better than expected loan and deposit growth, which as of 2 weeks prior, we thought we had positive checks on. Being aware of where those securities fell on a mark-to-market basis, I would argue allowed us to get out of that position at 9:30 in the morning on Thursday, because you could do the math obviously easily and say, all right, they took the loss on the held for sale security book, but we know what the held for maturity book looks like, and we know if people start doing the math where this could end up and it's zero, right? So we basically told our trader before the market opened, just dump it all in the open, and we were out, and we took like I think it was a 25
or 35, something like
percent
that.
loss on the position. I think
Better
being
than 100.
yeah.
That day, that was a loss that day as opposed to a loss in total.
Yeah. I mean, I think it had underperformed.
Which was 40% here.
Yeah, it had underperformed
A little bit into that, and then it's like, yeah.
Oh, was any consolation? I think Jim Cramer said it was a great stock in February.
Well, it would have been fun. The part you can't forecast is like Andreessen coming out and essentially causing a run by, like telling all of the VC funds to pull their dollars out. To your point, like if that wasn't out there, then it would have been business as usual. There would have been the mismatch, but there would be no issue without that kind of caused chaos. I don't want to attribute it all to him, but
Yeah.
What about, because right now as of March 31st, you have 8.9%. Is that mostly small banks in the financial side?
Yeah, so we don't,
No, we don't have any banking exposure in financials. It's mostly payments and.
it's a sure, it's like a Kinsale, which is a ENS, excess surplus insurer that's gaining.
So you don't have any more banks in the portfolio?
You know, we have WEX, which is it's a payments company that does like, they basically facilitate like fleet payments, but they have an in-house bank to basically facilitate those payments. They're not a classic bank as you would think, like a regional bank that where all the turmoil is today.
The only
So
other
if
bank.
you don't mind, can I circle back to what I was asking, what I asked earlier? What's the plan for 2023 and 2024? What lessons are you taking away? How's that feed into your continuous improvement? So,
Sure. So,
is where, we want to get a feeling for the future, not necessarily just. the
Yeah.
past.
Well, I think we were, as we look at the time, we were starting to move down the path, the market of leaning more into the secular growth. I guess the cooler print and the sentiment probably caught us a little more off guard than probably it should have, even though we had been moving in that direction. And once it did, we moved there with it at a faster pace, but if you had done what we did, maybe a month before, you would have performed a lot in, August or September versus, we have.
No, I know, it's tough.
And it's, you gotta turn
That time.
20% of the portfolio
Yeah, yeah.
over right at the same time. So, I think that we've seen that happen from time to time in the past, so we're cognizant of it. And we're very focused forward on like where we think the market's going and make sure that like the CPI doesn't, I guess, spin us around every other month at this time. And I think at this point in time, we're getting to where, the Fed's probably done raising rates. I mean, I guess never say never, but, looks like we're almost done. I doubt that they're gonna be cutting rates this year at this point. I mean, we'll see how quickly the rest of their policy flows in. But in general, we've been moving, because of that, we've been moving our portfolio more and more towards pure secular growth names, our true knitting, our true discipline.
Mhm.
Not that we weren't before, but
Yeah,
there's a defensive overlay to it. So, it's other than just trying to say, hey, we don't want that to happen to us again. We've seen it in the past, like I said, 2019, we had I actually remember being, I think we were third, fourth conference room here. We'd come in and a similar thing had happened to us, like in August when the Trump rally started. We lost maybe 500 or 600 basis points of relative performance in a month and a half. And then it sort of normalized as we got into 2020 before COVID hit, and our performance really did take off from that. But, in general, I think we're very focused on kind of what's going on in the macro. I think we're more comfortable with where things are going now. There was a lot of volatility with the interest rate debate last year. I think some of that's going to go away a little bit more going forward. So.
And on the continuous improvement, we are leaning on principal more heavily. We do monthly risk meetings with all the PMs at principal. So it's both domestic and international. So you share ideas, some of like the quant
That's good point.
data comes into play, and they can tell you, oh, you're out of whack on,
So you're getting more access to some equity factor models and
Exactly.
these sorts of things.
Yeah, and the last risk meeting that we attended, everyone went around the table and it's like, it almost suited us perfectly. It's like, where are you seeing the most positive surprise right now in the, both domestically and international, and what sector? So it's just additional information or knowledge that we didn't have, 2 years ago, and that we're leaning on a little bit more. The other one is our newest hire, Kelsey, who was previously on the R&D team at Principal, which is basically a quant team of some nature. Yeah, as she ramps her fundamental coverage, it's very early, so we are looking at ways to kind of not merge, but utilize her quant background with a fundamental basis as well. And that could be from a company specific level, but also hopefully maybe more from like a factor analysis, portfolio positioning perspective.
Where are you coming out in terms of the economy in the next, 6 to 10, 12 months? Is it hard landing, soft landing, low landing? Where do you think we're headed?
Well, I mean, I think we're probably headed at some point in time for some recession, but, we've been talking about it. I think that the economy's slowing, but it's not slowing at the rate that people, maybe some people want it to, or, it seems to be slowly deteriorating rather than, kind of seeing massive deterioration. The quarter we just went through, earnings overall were relatively good. I think I was reading that it was, like 75 or some percentage of companies, it was like 10 points higher than what the typical range had been, beat earnings, but that's also against the lowered bar as estimates had come down since the beginning of the year. So I'd say overall, despite the good quarters, that you saw weakness in certain metrics. I think it's mostly in tech so far still. You've seen a lot of weakness in some of these software companies that we don't have huge exposure to. We have, some small positions here or there, but overall, I'd say, it's there. You're seeing it in other things like backlogs coming down or not coming down, but backlogs not going up as aggressively anymore as people ship against the existing backlogs in some of the industrial companies. So, that
Then just like, very near term, we've seen like on the China side of things, the China reopen that everyone talks about. That's actually starting to progress slower than expectations or decelerate at least at a faster pace than expected. And then the other one on the retail side, which only probably in the last 2 days or 3 days, we've taken down retail a little bit because some of the, was it weekly credit card data that we can we track the higher end consumers starting to slow their spending. That's probably because where the job losses are occurring, right? It's in the tech kind of higher income levels. So we've taken down some of the retail exposure.
How do you weigh the China risk where basically anything can happen in terms of the government changing policy or adjusting things, and all of a sudden things that look so valuable become less valuable very quickly? How do you weigh that risk?
Well, I guess I'd say that we don't really have a lot of direct exposure to China. So it's always been something we've been somewhat skeptical of, especially since I guess probably Trump was in office and the relations began to deteriorate, and they've since deteriorated further. So if we're investing in something over there, it's generally has to be a pretty good, robust story. I think the only name that has real significant exposure right now is Wynn Resorts. That's a play on the reopening of the Macau area. We've owned that for a few months. It's been a pretty good stock. I actually sold some today just because I think that we're starting to see whether it's a week of PMIs over there. I think there's been some data going around recently that they're starting to see a second wave of COVID, or well, I don't know, second's probably not the right.
22nd, yeah.
Yeah, but they're seeing a renewed wave of COVID. How about that? So, and you don't really know what that could bring to them. So, but overall, I think our general operating premise has been that, there's probably US companies that are still shipping stuff into China and they're beneficiaries of what's going on there. But, how durable it is, and, we're looking for stories elsewhere in the world that we aren't playing the China economic growth and recovery of that economy per se, other than, like I said, look like a Macau right now. So generally our exposure is pretty low. So.
Inflows, outflows.
It's been pretty stable. We haven't lost any clients, nor have we added any over the last year.
Right.
So. That I guess we've become a bigger part of, kind of as we're what, 2 years past being put into the principal infrastructure. So we're starting to see some of the conversational activity pick up, throughout the organization, people taking a look at us. But I think, our asset class is a little bit out of favor right now. So,
Tough, yeah.
yeah, so we're, it's a lot of conversations, but it's not much happening, formally yet. So.
I mean, look at your benchmark, like performance. It looks like that like last year was it looks like -3.
Yeah.
And then this year you're positive 0.1.
Yeah, we're probably on negative side of that a little bit right now, like it was down like 20 or 30 dips on the year now as of like yesterday or today. So it's kind of been a lot of back and forth, a lot of fits and starts in terms of the ideas of where we get paid for them for a day and then they kind of
Disappears.
settle out. So last year, you know, the performance was really all about the fourth quarter and what I described to you there in terms of the junk rally. We got, you know, kind of run over by it and it started to normalize and things felt a lot better, you know, in March. It kind of been choppy ever since, but I think as the Fed, you know, takes their foot off the gas in terms of raising rates, growth slows, that should benefit our style. And so I'm hopeful that things will get better as we kind of go forward here. And they felt better at times, but it's very, very choppy still.
I'm good. Thank you very much.
Any other questions? Anything else you want to tell us?
I don't, I appreciate your business and I'm glad to have it today, but no, I think you've hit on a lot of what we would normally talk about, so.
Good.
Hope we
You're
didn't blow
still
up your
Stanford?
presentation too much.
Are you in Stanford?
And we were in
You were in
Stanford,
Stanford.
yeah, so we're sort of a hybrid model. We go in the city, you know, when we go into the office. So.
Thank you very much.
Perfect.
Thank
Thank
you.
you. Thanks for
Thank
your
you.
time. Appreciate it.
You take some sandwiches if you want on the way out.
Thank you.
Several.
Yeah.
Thank you.
Thank
you.
you.
Thank you.
Thank you.
Take care. Thanks, guys.
Any discussion on them? What do you think, Rich?
Be interesting to see what kind of added effect being under the principal does for them. You know, because they'll have more resources, you know, for example, bringing this person in to give them a little bit more quantitative feel. I would have liked to hear them say they had a more formal process on cell discipline. You know, everyone has a process to buy. Very few people have a process to sell, and selling is not always because the idea has gone bad. It's just as much as the market's gone up to you, or you have a better idea and you can deploy the capital differently. You know, they had that great 2020, and you know, I don't think we can count on that sort of thing again. So, you know, let's see what happens over the next year to 18 months.
Yeah, yeah.
Because that 3% cash really helps.
5% growth right there.
Well,
Well,
Or was
you
it-
might also say they knew they were in choppy waters and they wanted to. You know,
yeah, but by this, you know, it's the index doesn't have any cash.
Right,
And so if you have 3% in the positions to returning, you know, it's their largest position. Single position, and it's, you know, it's outperforming the index by 500 basis points.
And we're not paying them to manage.
Well, no, I mean,
Right,
but,
right.
no, we're not, but by the same token is that I'm not uncomfortable with the fact that somebody says, hey, you know, I don't see a lot of great ideas right now to deploy money,
Right.
so I'm gonna hold back, but eventually you have to do something with it, and so let's see what happens in you know, the 6, 12, 18 months.
yeah, I didn't know whether like one or two stocks just blew up on them. Do you know what I mean? Like, that was the one thing, but it didn't seem like that was the case.
And the fact that they get out of Silicon Valley
Silicon Valley,
Thursday morning, a
Right.
little scary.
yeah.
I mean, that could have been a much worse number for them.
Yeah, it was
that
a page 11 shows like 3 or 4 stocks that you know done really poorly. SVB, Silk Road, Credo down 50%, and United Therapeutics.
Yeah, I guess I thought, sometimes you just really blow them out, like,
Yeah.
like the bank.
Yeah, their first quarter number was probably not too good.
I mean,
And
to me,
historically, if you recall, they are a more volatile manager, so there is certainly going to be tracking error on the upside and downside. You can see that over the longer time periods where they have done very well at times, and in 2020, they did extremely well. But I think they have repositioned the portfolio pretty significantly from where they were in the fourth quarter, as Rich handed on in his questions. So I think the time frame to see how that repositioning works is certainly reasonable, and hopefully, their stock picking can outperform as it historically has.
okay. So we're gonna move on then to performance review?
Yep.
Is that gonna be,
Yeah, we're gonna kind of tag team it again. Does anybody need a copy of the report, the performance report for either the?
I'm good.
No? You-
yeah, I'm gonna take them just because
Yeah,
I think
Copy
I
of
have
each
a
of them.
copy here myself.
all right, so I'll just start
A
with
little bit of a
some.
hoarder situation.
Yeah,
but it's
Frank,
okay.
I get Columbus Circle going back a few years. I got everything.
There's Stearns, Lehman, you've got, yeah, you can sell them on eBay now, right?
Yeah,
All right, so I'm just gonna start with some kind of quick general market overview for March, and then Britt will step in and talk to the specific performance. The big news going back to March is something we've already been discussing a few times tonight, which was really the Fed stepping in and kind of quelling the turmoil around higher interest rates, as well as the collapse of a handful of banks, not just SVB and not just regional banks. We saw one, I should say, global bank go under as well, or get taken over. And one of the unique aspects that came out of all of that was the creation of something called the Bank Term Lending Program by the Fed. And this was really an effort by the Fed to create a backstop for the banking sector. And so what they did, for anybody that's not familiar, is they created this program which enables the banks to borrow against their bond holdings at face value for up to a year. And that's important because they're going to be able to meet potential customer withdrawals at any point in time without having to sell their bonds out in the market. And that is key because most of these banks' bond holdings would be sold for a loss right now if they were actually forced to do so.
Is it just treasuries or any bonds?
It would be any bonds. I mean, a lot of treasuries, you just think about the fact that most of what they're holding was purchased probably prior to the last 12 months, where rates have jumped by 400 basis points, roughly speaking. So they're getting caught right on that short-term trade. So the ability to just borrow off of face value is very meaningful, and hopefully over the shorter term will produce enough of a kind of insurance, if you will, and we'll see.
Buy
right?
some time for the
It'll buy-
market to
yeah.
rally.
That's right, that's right.
For
Maybe
the
rates,
bond prices to come up.
right, maybe rates come down a little bit.
That's what
bond prices
that's
go
what
up.
that's
So,
about.
And
the Fed doesn't show the losses on their books. They
They
just-
don't-
that's right.
Well, the problem was the banks weren't either.
I know.
Yeah, it's a little bit of a call to get your house in order.
Did you ever hear this thing called mark to market?
Well, where they really got screwed is that once they had to run on the deposits, they get rid of some available for sale. They don't have enough to sell at, and they have to go into the held to maturity. And once you suck that out, the whole
Everybody
held
gets
to
marked.
maturity gets marked.
Mark, right. Well, one of the things I think that Powell said in his news conference was how nobody's ever seen a run on a bank like this before. Guys can sit around with their phones and say, I want my money.
Yeah,
It wasn't like waiting in line, for them to let you in the door.
Yeah, that's a good point. And then there's all these knock-on effects now, right? Like the too big to fail. Well, we've just created even too bigger to fail, if you will, with the JP Morgans, right? Coming in, gobbling up regional banks. You're also taking away a lot of lenders to small businesses across the country, which is primarily with these regional banks. And so a lot more of that is now getting pushed to the private side of things, because the big banks don't play in that area because of, certain restrictions that were put in post GFC. So there's a lot of knock-on effect here that is gonna really kind of take some time to play out in the markets. So it's, we'll kind of see what happens. There's more to come. But the overriding effect was that we did see a boost to the equity markets anyway, because of all the central banks easing, concerns with pricing in lower interest rates going forward, as well as sort of the slower consumer demand, as well as moderating inflation. So for the month, the S&P 500 was up about 3.7%. MSCI EP was up 2.5%, and emerging markets was also up about 3%. So positive around the globe on the equity front. Fixed income side of things, we did see some downward pressure on rates. So treasury yields moved lower. We had the 10 and 30-year yield decreasing 42 and 24 basis points respectively, which is what we would expect given, everything we just talked about. So, so just some high-level comments. I'll hand it over to Britt to take a look at the portfolio.
Thanks, Kevin. Yeah, I think just one more comment. Year to date, we've seen growth significantly outperform value in the equity markets, which is a complete reversal from what we saw last year. And whether that's prolonged or not, I think remains to be seen. I think it's hard to decipher whether that's a rally because of the giant tech sell-off that we saw in 2022, or if we're really seeing growth going forward. But given all of that, I'll just quickly go over performance on the market value page. Total assets in the pension were about 467.4 million. You can see investment gains of about 4.5 million in the month. The plan continues to be slightly underweight to equities, largely within domestic equity. You'll notice that the transition from Artisan to Walter Scott in international equity occurred in March, which is great, and we'll continue to report on performance for Walter Scott going forward. I'm sorry, go ahead.
I was saying thank you to Chisame for
Yeah, agreed.
for that.
Agreed. And I would just note, you can see Blackstone, the market value down to about 9.9 million. We are expecting another distribution at the end of July. And then there's going to be, the remaining will be held back until the 2022 audit is complete. So that is nearing liquidation, and that global equity long short allocation should settle in around 4.5% once that is done. We turn to performance. Largely, your active managers have done extremely well. Fiscal year to date, you can see LSV has continued to do well versus their value index. They have now outperformed over the 1, 3, and 5-year periods, which is great. They really struggled in this growth market that we have been living in prior to 2022. We were hoping to bring LSV in to do a manager review at the next meeting. It's been a few years since they've been in, and I think it would be good to have them present to the board if that's okay with everyone.
Yeah.
Okay, great. We heard from Principal today. We know they struggled in the fourth quarter, which you can see playing out in the fiscal year and in 1-year periods, but over the longer periods, they've done extremely well. Silchester and BlackRock Emerging Markets have done well fiscal year to date, as well as the trailing 1-year period outperforming. And your global equity long short manager, ABS, has actually done a nice job, both fiscal year and over the trailing year on a relative basis. You can see for the trailing year, still down about 2.3%, but providing that diversification away from pure long only equity, which was down closer to 9 or 10%. On the next page, we show your fixed income managers, which have outperformed as well on a relative basis. The Prudential Core Bond Fund is a very conservative bond fund, and you can see that has been rewarded fiscal year to date in this interest rate environment. And both UBS and PIMCO have done a nice job for you in really providing that diversified return stream. So for the total fund through March fiscal year to date, up about 6.15%, slightly ahead of the benchmark. And you can see longer returns to the right, and importantly, over the 7 years, 6.85% over the benchmark and above the annual discount rate.
Am I reading this correct to say that cash has outperformed bonds over the last 7 years?
For this snapshot in time, Frank, you are correct.
Thank you very much.
Let the record show.
Let the record show. Who hates bonds? I hate bonds. Okay.
All right.
Anything else? Any other questions on performance? Next up then is going to be Trixie for cash deeds.
Oh, okay. So currently we have about 5 million. We still have 2 more benefit payments to get through June 30th. And we run about 3.3 million in benefit payments. We do still get current active employee that contributes to the pension fund, and that's run about maybe $300,000. So our net is about 3 million that we pay out each month for benefit payments. Right now, I guess I would be requesting just to have additional cash, maybe 3 million more.
When's the city money come in?
July. Yeah.
And that'll
it's
be
17.6.
17, yeah, 17.5. And then we also have the Blackstone additional 5 million that's gonna come in July.
And that's the last of the 4. Is that right, Brett?
It's the last of the 4, and then the rest is going to be held back until the audit's complete at Blackstone.
Do you know what time that would, do you have an idea when that would be?
I would have to look it up. I can follow up with you. My guess is it might be another 6 months.
Yeah.
So you'd like 3 million?
And so we actually did do an analysis. I'll just hand out copies real fast to everybody. Britt and I, based on the information that Trixie shared with us. It's pretty straightforward, just really based on current weights versus target weights, as well as obviously where we can access the money in terms of liquidity. So we would recommend that it be withdrawn from the PIMCO real assets. And you could see that about halfway across, when you look at the rebalance amount, you see the 3 million withdrawal there. And that'll help naturally bring that allocation closer to target post rebalance.
Just take,
Yeah, I mean, didn't we just take money out of them the last go around too?
That's right, but if you still, you can see it in the second column, the asset allocation as at the end of March, they're at 7.5% versus a target of 6%. So again, they're the most overweight, and if you want to be disciplined about your rebalance process, then this makes the most sense. I mean, even with the withdrawal, we're still overweight by, almost 1%.
Right, but one of the things, remember, the targets are a range, not a specific number.
I know we're taking profits out of the inflation play,
Yeah, that's true.
which is,
So we'll take 3 million out of
Yeah.
there. That's good.
Yeah.
so a motion to redeem $3 million from PIMCO real assets.
Is there a second?
I'll second that.
Any discussion?
Yeah.
All in favor?
Aye.
Opposed? No. Perfect. Anything else with you guys? We're gonna go into executive session. And so then we will hopefully see you in person next month.
I will see you in June, I can promise.
I noticed. Jake, can you stand up to make sure you get your pants on?
I can't hear you. I don't know what happened to the audio.
Okay,
Microphone's gone bad.
yeah,
Okay.
thank you.
Thanks,
Thank you,
Brett.
guys. See you
All right.
next month.
Thank you for being here.
All right.
See you next month. Thank you.
Yep.
Thanks, everybody.
Move to adjourn. A second. Discussion, if none, all in favor? Aye. Opposed? No. Yes, thank you very much.
Thank you, everyone. See you in June.
Thank you.
Nice to meet you.
Likewise.